Okay, let's start again. Let's do a review. Let's build a logic around this and use it to create a system.
Okay.
The moment price has been trading down in this Dangote cement for a long time, and has been trading below the moving averages.
Yes.
The moment price crosses above the 20-day moving average is an indication that, or is a pointer that there's a likelihood that the bearish trend is about to end.
Yeah.
Now, the moment price now did not go below the 20-day again, but instead rallied above the 50-day moving average in October, that is a breakout. It's a markup phase. It means that this is the point to accumulate.
Okay.
Do you get that? Now,
yes.
The smart investor accumulates around this level. Now, the moment price continues to rally and rally past 200-day moving average, which happened in November 2020, that is a participation phase.
Okay.
So everybody is now aware that Dangote cement is rallying.
Yeah.
So Dangote now got to about 250, where he found resistance, and there was sell-off, profit taking, which will definitely drive price down. Now, the trend, the bias is bullish because price is trading above all the averages.
Yeah.
That's one. Now, we are looking for when to re-enter Dangote cement because it is a trend resumption. We are looking at a trend resumption strategy now. The logic now will now be when price goes to 200-day moving average and act as support. That 200-day moving average begin to act as support, then it's a point of reaccumulation.
Okay.
Now, we've built a logic. We've built a strategy. Let's now add something to it to see whether there's a conviction. Immediately price broke through the 50-day moving average to indicate that you can accumulate or you can begin to buy. You will notice in the week in October, between September and October, we began to see a rise and appreciation in volume.
Yes, yeah.
So immediately there's an appreciation in volume, it means that there are continuous flow of funds in Dangote. So there's a breakout and there's an increased volume at the point of breakout in the week of 28 September.
Yes.
That is an indication that you should buy Dangote. Look at in the week of November when it broke through 200-day moving average. What happened to volume? The week of November, which is before that one, that's November 9, volume also increased.
Yes, there's increased volume.
So that's what we call directional conviction. There's a conviction that, yes, there's a breakout and there's an increased volume. It means that a lot of people are beginning to accumulate or beginning to enter the market. More funds are beginning to flow into Dangote cement. So there is a continuous rise in price and there is an appreciation in volume at the point of breakout. Currently, let's look at it currently. What is happening now? There's a gradual decline since when it got to 250 kobo. Look at that spike. Look at what happened there. This is an interesting one. On the 28th December, the week of 28 December. No, the week of 28 December. You will notice that there is a pattern formation called Doji in the candle. Doji means there's an indecision. Price opened around the same level. Price opened in the particular level and closes around the same level. But within the week, the buyers has pushed the price up and the sellers also pushed the price down. But at the end of the day, the price ended where it opened in the week. But something interesting happened there. The interesting part is we saw an extraordinary volume.
Yeah, but the price is still.
And the price did not appreciate. The price did not change that much. But there was an extraordinary volume at 250 kobo. When it hits the high of 250 kobo, there's an indication that there's an exhaustion in price in the trend, that there's indecision between the forces of demand and supply, but there are more transactions that occurred at that point. In the point of decision, there are a lot of transactions shared that exchanges hands. Is a point of exhaustion. If we had seen price appreciate significantly and we see increase in volume, we will say, okay, there's a continuous confirmation that the trend is still going up. But in this case, price hit an indecisive level and we saw extraordinary volume exchanging hands. It means that the smart ones are selling off.
Okay.
And some people are buying. So the smart ones that have accumulated when it was around 140, 135, 150, 160, 180, sold, because definitely volume must reflect the both transaction of the sellers and the buyers. So we saw an increase in volume, shares exchanging hand, but there was an indecision in price. Price did not appreciate, neither did it decline. Instead, it declined marginally, just marginally. It tells us that it's a time to be out of the market at that point. So back to the logic again.
Can we be recording this? Is there a way for us to record this?
I'm actually recording it.
Okay.
So there's a conviction now. Understand? Now that be off the market. So now let's come down to what has been happening since when we saw the high volume and indecision in the market. Back to the week that precedes that week, you will notice that the sellers now took control of the market. The buyers tried to take it up. The next week, the sellers took control on the 4th of January.
Okay, yeah, 4th of January.
Yes, on a lower volume. And the 5th, the next week, which is the 11th, you will notice that the buyers try to take the price up, push it up on a considerable higher volume, but price did not appreciate beyond 240 or 250, the high it got to. Now, the next week that precedes that.
Well, how come it's looking bullish?
Now, it means that the buyers were more in the market, pushed the price up. But was there a conviction? No. When I mean was there a conviction? Was there a breakout in the previous, in the resistance? No. And remember the thing about distribution. The distribution phases when it did not form an higher high, neither did it form a lower low.
Yeah.
So the next week that preceded that week, let's look at the next week. It's about 17th or so. 18th. You will notice that we had a bullish week, but volume was low. Yes. So there's a divergence. You have price appreciation, but there's a lower volume than what we had the previous week. So there's a divergence. And you will see subsequently, we began to see a lower volume. A lower volume.
The price was still lower. So the previous week.
Yeah, but the bull side tried to pick it up, but it was still on a lower volume.
Yeah, even the price. So if I'm looking at
the price, yes, was trying to, okay.
The close is 234 naira 20 kobo. Whereas the previous week, the close was 236 naira 32 kobo.
I think I would love to show you from this so that you have an understanding of that. So price, yes, the price appreciated, but it did not get to the previous week high.
Okay.
You understand?
It's a bit confusing.
So it did not get to the previous week's high. It gained. There was, when the price opened the week, it opened lower or closes higher, which is a bullish one, but did not get to the high it got to the previous week.
Okay.
So it means that we are still in a ranging market. And now you now continue to see it continuously. You continue to see a lower price trending within the range, and the volume is reducing.
Yeah.
Continuously reduce. So it means that we are having a weak trend. There's a divergence between price and volume. So these are what we want to do. What you want to use volume to do is to confirm the direction of the direction of price, or the movement of price. If we see an increased volume when there's a breakout, we say yes. We say the trend is in a particular direction. There's a conviction that the trend will continue that direction. But when we see that price begin to appreciate and volume begins to reduce, it means that there's a divergence between price and volume.
When price appreciate and volume reduce,
there's a divergence between price and volume. These are part of those things we will treat today. Now, one thing I'm okay with now is that you're able to understand, create a logic using moving average to determine the trend, to determine when trend has ended, or when trend is about to end, and when trend is just starting, and also when you are to re-enter the market. Am I good with that?
Yes.
Good. So we now want to further go, we want to go further ahead. So now use price to confirm our trend.
Okay.
Okay, so just give me one.
To stop sharing so that you can take over.
No problem. I can stop it from.
Okay.
I hope you can see my screen.
Yes, I'm seeing your screen.
Okay, so we want to work on how to use volume analysis to confirm the direction of the trend. So, okay, so we want to use volume analysis to confirm our trend. One other thing about it is that for the stock market, volume goes a long way. Volume helps us to know who is driving what between the suppliers and the demand side, between the supply side and the demand side. Volume shows us the relationship between the buyers, the demand, and supply. And it helps us to define, like what I did the other time, helps us to know whether there's a strength in the trend or there's a weakness in the trend. It helps us to know when there's a conviction that the trend will continue to move in a particular direction. And it also helps us to know it can also give us an idea of when the trend has ended. Now, volume is very key. It helps us to know the health of a trend. With the volume, you can know how much of a given financial asset that is traded over a period of time. Now, the volume indicator is a powerful method. If you are observing it in relations to price, you look at the relationship between volume and price, and there are a lot of things that it could tell you about the trend. So when you're looking at a particular trend of a particular asset class or stock, except for FX, who doesn't have a central volume. When I'm talking about volume, I'm talking about central market. FX doesn't really have, just, volume differs.
Okay.
You use volume in the stock market to be able to, technicians use it a lot. You'll be able to give you an idea of the strength and health of a trend. It gives you an idea of when there's a likelihood that the trend will change. It gives us an idea of when there's profit taken in the market. Now, these are principles in volume. Now, when you have, let's look at the relationship between price and volume. Now, you have price rising day by day, or a continuous rise in price over a period of time. And you see volume also increase over this period of time. It means that the trend is strong and there's a likelihood for more uptrend.
Okay.
Now, when you now see a rising price and a falling volume, that's a divergence. It means that there's a weakness in that trend, and the trend is a suspect. The uptrend is a suspect. Now, when you see price falling continuously over a period of time, and volume is increasing over that period of time, hello? Hello, so sorry, it's from my end.
Yeah.
It's from my end. It's from my end.
Okay.
It's from my end.
Okay.
Okay, so okay, we are in this the third part of it. When price is increasing, reducing, falling, we continue to see continuous fall in price, and you see an increase in volume. What it means is that a lot of people are supplying day by day.
Okay.
So price will continue to trend down.
Okay.
So that's why you are seeing a strong trend on the bearish side. The first one, an increase in volume, an increase in price, and there's an increase in volume. It means that a lot of people are ready to demand day by day. That's why you are seeing a strong trend on the bullish side. While the third scenario is that a falling price and increasing volume. It means that there is more likelihood there will be a more downside movement to price. Then finally, you see a falling price and a falling volume. It means that there's a resistance for people to supply. That is a weak bearish trend.
Yeah. Yeah.
I hope you get that.
Yes. I'm clear. It's clear.
First scenario, when you're looking at the price, when you're looking at the chart, and you place your volume on it, you want to look at if the trend is on a bullish trend, and you're saying there's an increase in volume every day, it means that the trend is strong and there's a likelihood that there will be a continuous upside movement.
Okay.
But when you now begin to see price fall and volume also fall, it means that yes, the price is falling. There are people selling, but there is still resistance for them to sell. At that point, it means that the downtrend is weak and there's a likelihood that it may change because the downtrend is weak. So it gives you a lot of things. If you're to just you have to look at, let's look at the same Dangote that we were looking at.
Yeah.
Now you notice that price is reducing, it's falling. Am I right?
Yes, it's falling.
And volume is also falling.
Yes.
It means that this downtrend that you're seeing is weak. This can be seen as a corrective trend, a correction. This can be seen as a corrective trend.
Okay.
Now, this downward movement could be seen as a corrective trend. Why? Because corrective move, because volume is price is dropping, volume is dropping. If we had seen price dropping and volume increase,
yeah,
then we would have said it is not a correction, it is a distribution.
Okay.
But in this case, price is just weak. Volume is also weak. The interpretation is there's a resistance for sellers to sell, despite the fact that the price is dropping. Let's look at the situation. Yeah. Let's look at this bullish move. Price actually had a bullish run. Let's look at what happened to the volume over a period of time. Volume also increases. I hope you get that. So over a period of time, volume increases. So you now say that there's an increase in the trend is likely to continue. But when we got to a point of exhaustion, let me add this indicator.
Okay.
Volume indicator. We got to a point of exhaustion where volume got to an high and it began to fall. This is a volume indicator. Now, when price was increasing, you saw volume also increase.
Okay.
Now, when price was reducing, volume was also increasing. When price was declining,
yeah,
volume was increasing. Look at a particular scenario. Look at this. Price was increasing, was rising, volume was declining. The volume indicator was showing decline. That is a suspect that this uptrend is weak. It's not as strong as we term it to be. You understand? So what volume does is this in our case now, and how we want to use our volume is to say, when there's a breakout in all the averages, do we have an increase, a breakout in volume? So volume helps us in the directional conviction. Let's look at this for instance now. This is a guaranteed trust bank chart. Now you'll notice when price was declining, the volume was increasing. It means that the downward momentum is strong. Now we now go to a point where as it continues to decline, volume began to decline too. So it's a point where it tells us that there's a weakness in this trend. Later on, we now saw a pickup in price begin to appreciate and volume begin to increase until we got to a point where there's a divergence between volume and price. There was an increase, but volume was reducing. It means that this upside momentum is weak.
Okay.
Now we now got to a point where it was now a consolidation phase where we now saw volume flatten a bit. Then we now see another rally, upside rally, but volume was reducing. That's also a divergence that this moment, this upside rally is a suspect. And that was 2017. Let's look at what happened. That was 2017 July. Let's look at what happened afterwards. Let's go GT Bank. 2017 July. So let's look at whether volume worked. When it was moving up and volume was reducing, it was appreciating. Let me go to this point. And volume was reducing. Let me find it out. I think it's about this angle. Though we had an extraordinary spike. Now, the trend continued, but it was a suspect. Remember, it was a suspect.
Yeah.
And instantly, what occurred next? It began to see a decline in price. So it was a suspect. Price was going up, but the volume indicator shows that it is what? Trending down.
Trending down.
So despite the fact that it was appreciating, but the trend is a suspect. So as a technical analyst, what are you looking for? Exit at the next resistance or at the major resistance, so that you are not caught unawares.
Okay.
So that being said, that's GT Bank. Let's go to another example that will show. Breakout. When we saw a breakout, Access Bank, we saw a breakout, and you will notice we highlighted volume. When there was a breakout in the high, we saw a higher volume. When there was a breakout, we saw a higher volume. When price got to resistance point, we saw an higher volume. So you must note it. Volume is a way of confirming directions. It confirms the trend. It confirms the breakout. It also confirms the strength and weakness of the trend. Now, exhaustion point of a trend. In a rising and falling market, we can see exhaustion moves. They are generally sharp moves in price combined with a sharp increase in volume, which signals an potential end on trend. There will be a particular day when there is a continuous upside trend, or upward movement or a downward movement. There will be one day you just see an extraordinary volume. That day is a point of exhaustion. I remember vividly the Dangote we just looked at. You will notice that the volume that we saw here, we saw something like that in about May, in about March. In about May. But look at what happened. This is more important. This is it. Look at this volume. Happened at this high. Is an exhaustion move, extraordinary volume that had not occurred for a long time. That is an exhaustion move. And when you see an exhaustion move, price gets to a resistance point, and you now see an extraordinary volume, is a point to say is an exhaustion point. It's a time to leave the market. So that's what this is saying. Even at the bottom, at the market bottom, when you see price falling, a falling price, and you now see large number of eventually falls out large numbers of traders, resulting in volatility and increased volume. You just see high volume traded at the bottom, it means that the bottom is also has exhausted its strength, and there's a likelihood that the buyers will come into the market.
Okay.
I remember vividly there was a time where Afri-Put, we saw this exhaustion move. You see this exhaustion move at resistance. You notice this last circle I did here. They are exhaustion moves.
So the exhaustion moves, do they only happen at resistance levels, or they can also happen at support?
They
levels?
both happen at when they happen at support level. It tells you that the bearish movement has exhausted its strength, and there's a likelihood that there will be a change in trend.
Okay.
Exhaustion move signals a change in trend. If it's at the top, it means that there's going to be a likely change in trend to the downside. If it happens at the bottom, there's likelihood that there's going to be a change in trend in the upside. Look at this, for instance, now. Look at this exhaustion move.
Yeah.
Look at where it happened. So what happened subsequently? There's a change in trend.
Change in trend.
When you see it at the upside too, what happened? There's a change in trend. Look at this exhaustion move. There's a change in trend. So you can see it at the bottom, you can see it at the top. But what makes it a bottom, remember, is it must be a significant bottom. By that, I mean a significant support that has been tested at least 2 times.
Okay.
So this is a signal. Currently, we saw that in Dangote, exhaustion move. I don't need to be in the market at that time. Let's look at, do we see something in the FBNH? Let's see. I think we did saw an exhaustion move too. Look at this move.
Yeah.
Look at the day, look at that day, that same day was the day it got to its peak. And was that peak a resistance point? You see, it's a resistance point.
Okay.
So we are trading with logic here now. We are not just, so there's an exhaustion there, isn't it?
Yeah. Yeah. Yeah.
What now happens subsequently? We saw price down.
Decline.
It declined. So that's how to interpret it. So when you see this kind of move, when you're looking at your chart every day and you see this kind of move, it tells you that be careful of the trend, be out of the market, and try to see, look for other opportunities or wait for correction. Now, the volume strategy. I said the breakout strategy. When you see when a breakout occurs at a resistance or support, whether dynamic resistance or static resistance on high volume, then the rally is expected to continue, and it shows more optimism. Thereby, further rise is expected. The same thing, on the other hand, a breakout with a low volume shows that the expected new trend is a suspect, and that should not be taken seriously until proven. So there is no conviction.
Yeah.
Because yes, there's a breakout, but do we have volume to back it up? Remember what we saw in the Dangote. There was a breakout of 20 days. There was a breakout of 50 days. There was a breakout of 200 days. There was volume to back it up. You understand? Hello?
Yes, I'm with you.
So there was volume to back it up. So that gives us a good a conviction that the trend will continue. But when there is no volume to back it up, it means that the trend is a suspect. It could be a false breakout. So be careful. Now, when the market is trending, now the first one is a breakout.
I'm a bit confused. Go back to the so when a breakout occurs at resistance and support. Okay, the one we talked about previously is not a breakout. We had the trend changed.
Yeah.
That one is not is that one a breakout? No. The breakout is when it crosses the
breakout.
resistance.
Yes, the trend has changed. It means that there's a breakout.
So when we have increase in volume, at the point where the trend reverses.
Yeah. There is a conviction that the trend will continue.
Okay.
But if the volume did not increase,
yeah,
there is no conviction that there's a change in trend.
Okay.
So it's a suspect. It could be a false signal.
Okay. All right.
Now, when the market is already trending, price is moving higher high, you expect volume to also continue to increase. But when price is also moving, let's say lower low, you expect volume also to increase.
Okay.
But immediately price is forming higher high and volume is reducing, then it's a suspect.
Okay.
No. Then there's what we call a volume spike. Look at the volume spike, like we saw in AfriProd, and the one I showed you the example in Dangote, and the one we even saw in First Bank. You just saw a spike, a day that is a spike, and it happened at resistance or happened at support. Then it tells you that there could be a likely change in trend. Or the next few days, you will likely see an opposite direction of the existing prevailing trend. Look at the first breakout, a breakout around key resistance and support on low volume. Let's explain that. So this is still the example like that. So using volume analysis to trade the market is like you're using it to confirm a strategy.
Okay.
It's an important tool that I always encourage stock traders to employ. Though we overlook it, but it's very, very important. It gives you a lot of.
Does this also apply to FOREX?
No, the issue about the FOREX angle is that FOREX doesn't have a centralized markets. So you get the volume based on the broker's transaction, retailers on the broker's transaction. That's what you get the volume. So there's no, the volume in a particular broker is different from the volume that another broker.
Okay.
So in centralized market exchanges, the volume is always the same thing.
Okay.
That's why I don't encourage the use of volume in FX. Instead, you can use oscillator indicators like RSI, stochastics, MACDs for them.
Okay.
So in trading and stock, it's better to use volume to confirm the breakout or to give you a signal of an exhaustion or to help you know the strength and weakness of the price trend. Yes, there are other indicators which I briefly explained here. We have the RSI, Relative Strength Index. We have the relative strength index, which you can use. It's also is an oscillator indicator that you can use. You understand? You can use that to determine your overbought, your oversold, your divergence, your positive, negative. I use it mostly not for stocks. It has its advantages. Yes, it gives you when a particular stock has been oversold, and tells you when the particular stock has been overbought. But again, that is just a leading indicator. So I'd rather say experience over the years has shown that price, volume, and patterns, using price, volume, patterns, and key levels are effective tools for trading the market, especially the Nigerian stock market. So, hello?
I'm with you.
So you can take time to learn the RSI and its use, but I prefer to work around price patterns. So let's look at the final lap of this. I know you have an idea of this, but let's brush through it. We'll now combine everything together. Though we've been combining them, but we'll now begin to incorporate the new ones into what we'll be combining.
Okay. Can we take a break of 5 minutes, please?
No problem, no problem.
I need to do a quick transaction to my sister.
When you see the patterns occur at a significant resistance and support level, now their way of confirming your conviction, their way of telling you that your decision has higher probability of succeeding. Remember, the world of trading is all about probability.
Yeah.
So it gives you higher probability of succeeding. So you have a double top, you have a triple top, you have a false breakout, trend line breakout, a broke out and came back in. I think we did this resistance reaction. There are a lot of them, but I'm going to brush through and we're going to look at some candlestick patterns that I want you to take note of. I know you understand candlestick when you have body, upper shadow and lower shadow. Yeah. So you are not new to it. So we have Doji. The first one which we want to look at is Doji. Doji is an indecision when price opens and closes at about the same level. So it means that there's an indecision. The implication is that the bulls and the bear are in a state of indecision. So when you see Doji, like what we saw in First Bank earlier on, or what we saw in Dangote, immediately you see a Doji at a resistance. It tells you that please be off the market. There's an indecision. Wait for a decision to be made before you can say you want to continue the trend. Especially when you now see it at resistance, and the next candle is a bearish candle. It means that there's a bearish reversal. Be off the market. So the position is when you see Doji at support, it tells you that there's an indecision. Either the buyer, the bulls will take control, or the sellers, bears will take control. So wait for the next confirmation to know what to do next.
Okay.
We see Doji a lot. We see long leg Doji, gravestone Doji, dragonfly Doji. They are all Doji. Most importantly, you want to understand psychology. The psychology behind this is the buyer, the bulls, and the bear. They are in a state of indecision. If they are in a state of indecision, then you don't need to be in the market. You need to wait for who is going to have the edge subsequently.
Yeah.
Let's go to AMA. I hope you know something about the AMA. This is an AMA is it has a small body and a long shadow. When you see an hammer at the resistance or at the support, it means that it's a reversal signal. There's a likelihood for a reversal to occur. So when you see it at resistance, it means that there's a likelihood that the next move, subsequent moves will be bearish, will be sell-off. When you see it at the support, it means that the next move may likely be bullish. I think I saw something like, let's look at something that I saw something very interesting around. This is okay, Euro USD for instance. This is one pair that I've been trading since yesterday. And sorry, I have to dive to FX. I hope it's okay.
Yeah, it's okay.
Okay, good.
Because even in the future, I intend to go into FX, but I want to first of all master stocks.
No, please do. Please master stocks. So look at this now. We saw a doji. We saw like a spinning top. We saw like an hammer. We saw like a spinning top. This is a state of indecision. Now, something interesting happened. You will notice I drew my Fibonacci.
Yeah, I see the lines.
Now, it occurred at the 50% Fibonacci, between the 50% Fibonacci and 61.8 Fibonacci level.
Yeah.
So yesterday, I needed a confirmation. So this formed like the bears took control of the pair. Now, because the bears took control of the pair.
Is that a red candle?
No, a bearish candle because it's black. The black is a bearish, the white is bullish. So the bears took control. So it gave me like a confirmation that this 50% Fibonacci serves as a resistance, dynamic resistance. Then immediately the market closed yesterday about 10-11 p.m. yesterday. I took a sell order because I knew there's a confirmation after all this state of indecision. So when you see an hammer, this is an hammer. The previous day did not confirm it. The next day we did not confirm it, but on Thursday yesterday, yesterday Tuesday confirmed that it's going to resume the bearish trend. So I took a sell. So when you see this, then what's my expectation now? You see, I'm working my Fibonacci. So my first level of profit taking is about the 100-day moving average around this level. Then the final one will be at the extension. Now let's go to the all share index. Let's see whether we'll see an hammer. This is a typical example, very good. This is an hammer. This is an hammer. So what happened next? We saw Doji or spin it up. What happened next? We now began to see a downward movement.
Okay.
So when you see it as significant resistance and support level, look at an hammer. So this is another hammer. This is another hammer. But when you see it, what happened? Downward movement. So when you see it at the top or at the supports, at the major top or at the major supports, it tells you that the trend is likely to reverse. Look at another one. This is a bullish one. At the support, what happened? It continued upside movement. So it's a reversal pattern. Read more, try to observe your charts. I don't expect you to just know it. The angry man is the opposite of an hammer. It's still an hammer, but it's just where the shadow is that differs.
Yeah, it's inverted.
Yeah, so it's just the inverted hammer. We call it inverted hammer. So the angry man is an inverted hammer. So just then I use the engulf pattern. Now we have the bullish engulf and the bearish engulf. It says the bullish engulf when the current candle, when the immediate previous candle enters into the body of the current candle. So in a downtrend, it has been bearish. You now see a bearish engulf. The body is so big that the previous body of the previous candle can enter into the body, into this. So it's a bullish engulf when it happened at support. Let's look at whether we'll see something like that. Look at this, for instance. This is a typical example. Look at the body of this one, the bearish candle. It has been in a downtrend. You now see a bearish candle. You now see a bullish candle, isn't it? The next one is a bullish candle.
It's a bit tiny. I can't see it very well.
Okay, good. Let me. How about this, like this?
Better.
So you see, it has been a downtrend. You now see a bearish candle. The next one formed a bullish candle. The body of this bearish candle enters into the bullish candle, isn't it?
Yeah.
Conveniently, this can engulf this. So that is, it tells you that there's a possible reversal in trend. What happened subsequently? We saw the price move from 5 naira, 50 kobo, thereabout, to 7 naira, 75 kobo. That's a 2 naira gain. So you see that that's a bearish bullish engulf. The opposite is the bearish engulf. The bearish engulf is when you see that resistance. Same thing is the prevailing trend is an uptrend, and you now see. Let's see. I think I saw something interesting like that. Look at this, for instance. The prevailing trend is an uptrend, and you now see a bearish engulf. This can enter into this. So there's a likelihood that we may see a further decline in GT back by using the patterns. Let's look at the Dangote. This is also a bullish engulf. It's not in the bearish engulf. If I should zoom it, I think I should be able to see one at the resistance. It's not here. Okay, let's look at the NSE or share index. You can still find one, but then of course, okay, this is bearish engulf. It happens at the resistance. The most important thing is it happens at the resistance. Yeah, we have the piercing pattern. This I don't really, you can just brush through them. But the major ones, we have the piercing. Okay, let me explain the piercing patterns and the dark cloud cover. When we say the piercing pattern, the prevailing trend is a downtrend. And you now see a bullish move, a bullish candle that formed after the last bearish candle, confirmed by the subsequent bullish candle. So it's called piercing pattern. The bearish, the bullish, and the next one that happened gapped from the middle of the bearish, crosses above the middle of the bearish as a bullish candle. So that's a 3-candle reversal pattern. So it's called the piercing pattern. We said that
for this piercing pattern now, do we need to have those 3 bearish candles?
Yes. No, what it means is that the prevailing trend is bearish.
Okay.
So the last trend is bearish. The last candle is bearish, followed by a bullish candle that closes above the midpoint of the bearish candle.
Yeah.
Then confirmed by the 3rd candle, which is a full bullish candle.
Okay.
Now, the opposite of piercing pattern is dark cloud cover. The opposite of bearish is piercing pattern is dark cloud cover. The prevailing trend is bullish. You now have a bearish candle. Then there's a third confirmation. That's a 3 candle confirmation candle. I need to have put that in there. There are a lot of them, but the major ones, I just want to take you through the major ones so that you
It's like the slide you gave me does not have this.
No, this is another new slide. I'm going to send you this one. This one,
okay,
I'm going to send it to you. So this I'm going to send to you. You see the inverted hammer. Okay, so I think we'll cover gaps. Let's cover gaps because it occurs on the stock market a lot. Then we will now put everything together. We had our pattern, our trend, our levels, then we generate our signal.
Okay.
Now, I know if you're observant about the market, you will notice that sometimes if you look at the market very well and it closes on Friday in a particular level, by the time it opens on Monday, it either gaps up or gaps down. Have you ever seen that? Okay, good.
I'm aware of that phenomenon.
So
I've seen it too in some graphs, in some charts.
It happens, and it happens on stock market a lot. Now, when you see a gap, we have 3 types of gaps: breakout, breakaway gap, runaway gap, and exhaustion gaps. Now, when you say that something is a breakaway, now from the supports, or when the market is ranging, and you now see the gap above it, it means that it has broken away from either the channel to begin a new direction. That's the breakaway gap. So that's the breakaway gap.
Yeah.
Now, let me see. Let me just try. Let's be practical about it so that let's go to daily time frame a lot. Let me go to the Dangote that you looked at. The price did not open where it closes. It broke out away from it. It's a breakaway gap. I'm trying to find a channel. Let me see. I know there are some stocks, but most of the insurance stocks are the one you see around this. All of these insurance stocks, they form a lot of breakaways. Look at this, for instance, now. We have the breakaway, we have the runaway, and we have the exhaustion. Hello? Hello?
Yes. Yes, I'm with you.
Okay, we have the breakaway, we have the runaway, and we have the exhaustion. A breakaway gap is seen when during a channel movement, and you see price break below the support in the channel to start a downward move, or break above the resistance in the channel to start the upward move. That is the breakaway gap.
Okay.
And then runaway gap, of course, in an established trend. So the trend is an uptrend. You now begin to see gaps that occur. Let's look at this. This is an uptrend. You begin to see gaps. Price opens above the previous day's close. Price opens above the previous day's close. That is a runaway gap. I think the gaps are always. Let me show you crude oil. It's very. Let me see crude oil. Let me see. I know I see a lot of gaps in crude. I'm trying to find crude oil so that I'm actually crude oil. UK crude, no, not here. Fancy futures, no. I'm trying to look for. No, I couldn't find one yet. But in the crude oil market, I know Brent crude there's always a breakaway and a runaway gap around. You see price opens gaps above where it opened higher above where it opened, closed the previous day. So, but when we say runaway, it means that it occurs in a prevailing trend. Then the last one is called exhaustion gap. The exhaustion gap is when it got to the top. Let's see. And there's an exhaustion, like what we saw in Dangote. Remember when we talk about volume, the exhaustion thing?
Yeah.
Okay, good. This is an exhaustion gap. Sorry. This is an exhaustion gap. Sorry, this is an exhaustion gap. Now, by the time the price closes here, it's opened higher here, but at the end of the day, it goes back down.
Expand a bit.
Let me expand it a bit so that you'll be able to see it. So what I mean is this. The price closes, this is a bullish candle. It closes at this point. You expect it to open here. Instead, the price opened above.
Okay.
And closes down below. At the top is an exhaustion gap.
Okay.
So you have the breakaway, the runaway, and the exhaustion gap. When you see this pattern, they are just ways to further confirm that the trend has exhausted. Just a further way to confirm. So they're just tools to help you further confirm. That's just what they do. Okay, I think we've treated most of the things in this slide. I'll share with you this slide. The only thing I didn't treat you is Fibonacci, because when we go to the advanced phase, I'm going to take a Fibonacci one after the other. Fibonacci is another topic on it. So we treated moving average, so where you looked at moving average using that. So, but I'm going to teach you more of Fibonacci. I don't use the oscillator indicators for my stock market.
Okay.
I personally have backtested it. I've not seen that as effective. It should be, yes, personally for the Nigerian stock market.
Okay.
For other markets, yes, but for the Nigerian stock market, I've backtested it severally, and I've seen that it has not been that effective. So I don't waste my time on it. Now let's put everything together. Let's put everything together. Let's go down to when to trade, what to trade, entry rules, risk management rules, profit management rules, position sizing rules. Okay, so now one of the things you must learn is entry the trades properly. You must learn how to monitor your trade, exiting the trade. Let go of here, go okay. Oh, okay. Let's put everything together. Three things you must note. Let me try to. Please, the first thing, while we are putting everything together, first of all, what is the trend? The second thing you must notice, what are the key levels? What are the key levels? When I mean key levels, I hope you understand it.
Yes.
I mean resistance and support. Resistance and support levels.
Okay.
So you want to look at what is price? Where is price in relation to these levels? I hope you're getting that.
Yes.
The third thing is this. You need conviction. What helps you in conviction? You need volume and patterns. Then the final one, which is setup. The high probability trade setup. Now, what is the trend? Which means that you want to know your bias. You want to define your bias. You want to define it. Now, you want to know whether it is bullish or it is bearish. We did a run through around it with the moving average, isn't it? And that is actually, that is why you will see on my chart every time, I always have my moving average plotted on it. I have the 100-day and the 200-day. Yes, 20 days, very good too, for short term.
Okay.
Why? I want to use that to determine the trend. Is the trend up? Is the trend down? Is the trend about to end? After I've done that, I now begin to plot my resistance and support levels. If the trend is going up, I begin to drop my support, my resistance. I begin to drop my support and see, because if I am buying, I want to buy at the dip. So I want to buy an institution where market is getting to support or has corrected to support. If it is a breakout, I want to know whether there's a breakout of resistance, then I do my buy. Now, conviction now is I want volume and pattern to confirm for me. If it's a support, I need higher volume and reversal pattern. If it's a resistance, I need higher volume and reversal pattern. If the trend is in motion, I need higher volume. I don't need pattern, because that pattern is not significant when the trend is in motion. It is only when the trend is getting to a key support and resistance level that pattern is more important. And that gives you my setup. Simple.
Okay, at key levels, we are looking at volumes and patterns.
Patterns, yeah.
Okay.
In the direction of the trend.
Okay.
So that is just the simple thing. Now, with this basic 4 foundational steps, you can begin to begin to create your own indicator. You can say, okay, I don't want to use moving average for my, moving average to determine my trend. I want to use another tool to determine my trend. These are the 4 basic principles. You can say, I want to use Bollinger Band to determine my trend. That's one. You can say, okay, I don't want static resistance and support. I want dynamic resistance and support. So I can go for Fibonacci, I can go for Elliott wave, I can go for pivot point, I can go for any other way of determining my. Then you can say, okay, now that I've been able to determine these two, I want to use volume to confirm my trade. I want to use patterns to confirm my trade. This gives me high probability setup. So simple as that. That is my family. That is everything I do is around this.
Okay.
The other thing is just the risk management. How do you allocate your fund? What amount do you allocate? What percentage of your fund do you expose in a particular stock? That is relative. I can decide to expose 50%. You can decide to expose 10% of your capital. You can say, okay, I want to use 1% of my capital to buy a particular stock. So, but I usually recommend, if it is a stock market, don't use more than 5% of your capital for the stock market. If it is the FX market, don't use more than 2% of your capital to trade to expose yourself in the FX market. That's my own recommendation.
So, like for Nigerian stocks, that there is no leverage.
Since there's no leverage, use your fund. You can use all your fund, but by the time you see that the value of your stock is depleting by a particular percentage, exit the market. If you can say, okay, I'm using my fund, but if it depletes by 5%, 10%, I am going to be off. I will look for another stock. Good. But for the Nigerian market, what I do is I expose few, I let it run, and when there's depletion, because normally there's a standard when the market is in a full bullish move, it can move 10%. So 10% can happen within a day. It's no big deal. But for the high cap stocks, relatively stable ones, you see 5%, you see 3%. So that is still relatively okay. I can say, okay, I'm risking 10% of my capital base to buy a particular stock. If it depletes by 20%, then I exit the market.
Okay. Wow. I'll need to go through those slides and then.
No worry, I'll send you this slide. I'll send you this slide. I'll send you this video. Yeah. Now I think we have time between now and our next class, which will be on Saturday or Sunday. Am I right?
Yeah, I'll be available Saturday or Sunday. Any of those
okay, good. So we would have enough time. You go through this slide. You would have. I want you to practice it. So what you want to do for me now is to begin to identify traits based on these 4 simple principles, 4 simple steps. No stress. Don't stress yourself. It is these 4 simple steps. You don't need to stress yourself around it. It's as easy as that. So it is the 4 simple steps. You don't need to stress yourself. Define your bias. 4 simple steps. Follow them. They use those tools.
Okay.
I don't expect you to know everything at a go. But I expect you to practice them. And
okay, no bother.
So
I would
pick out some trades from me. Practice a lot. Pick out some trades for me. Then we'll now move to our advanced class where we now begin to work around advanced tools. Then remember I said the tool is, if you look at it, you define your trend using moving average.
Yeah.
Then you can now go to your fundamental and say, okay, is this stock fundamentally okay? Then you now come back to technical.
I don't know how to do that fundamental set.
The fundamental is another domain itself. So don't worry. I'll just give you a brief of what I look at in fundamentals. Okay. Now, the next thing you now be come to technical and say, what are the key levels? Do we see patterns? Do we see reversal? Is there going to be a breakout? Is it going to be a reversal, or a change in trend? Then you take a trade. Okay, so hello?
Yes, I'm with you.
So what you do for me is this. From now to the time you have our next class, use these 4 steps to pick out, to backtest at least 3 different stocks. So you want to do a backtest, and you want to follow these simple steps. I hope you get that.
So the backtest now is for me to check
when these 3 criteria aligns.
Okay.
And what did it tell you? Did it tell you to sell? Did it tell you to buy? Note it, note the date, note the price. Let's look at the market reaction afterwards.
Okay.